Hello, I'm Carla Wakefield, and this is our Week 5 discussion on stocks and interest. First, I will be discussing the differences between privately held versus public companies. Privately held companies are small companies with common stock that is not publicly traded. Generally, capital is obtained through private investing, business loans, or venture capital. While the term venture capital does not have a precise meaning, it generally refers to financing for new high-risk ventures. Larger companies, on the other hand, with publicly owned and traded stock are known as public companies. These companies are frequently listed on several stock exchanges, such as the New York Stock Exchange or the NASDAQ. Those who purchase stock are called stockholders. The selling of stock or securities by a company helps to generate cash flow, which can then be invested in the company, used to pay taxes, or used to pay creditors. Public trading, such as the buying or selling of stock, must be registered with the Securities and Exchange Commission. The Securities and Exchange Commission, or SEC, is the government agency that oversees the stock market and is primarily concerned with promoting the disclosure of important market-related information, maintaining fair dealing, and protecting against fraud. The mission of the U.S. Securities and Exchange Commission, or the SEC, is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. Furthermore, the SEC helps ensure that companies offering up their stocks for public trading are telling the truth about their stocks, the stocks or the securities they are trading or selling, and the risks involved with purchasing those stocks. In other words, they are there to protect the investors. They must follow through with any company wishing to issue public stock to trade to ensure that the company has filed a registration statement with the SEC, which includes providing financial information such as their company history, details of the existing financial business, proposed financing, and plans for their future. Next, we will turn our attention to a few definitions. Interest expense is the interest charged on the remaining principal of a loan. It is also known as the cost of borrowing money or the return on lending money, depending upon if you're the borrower or the lender. Interest rates are frequently stated on an annual basis and are calculated at the principal amount times an agreed upon rate of interest times the amount of time of the loan. When looking at loan costs, they are the expenses associated with closing a loan. Some of the costs are listed in the current year, while others are spread out over several years. There are several expenses included in loan closing costs, such as attorney fees, title search fees, title insurance, taxes, lender costs, and some upfront housing expenses such as homeowners insurance. When looking at the importance of deciding whether or not to obtain new capital, it is crucial for the financial manager to know the overall financial health of the organization and how obtaining additional capital will impact the organization as a whole. Having to repay a large debt load can severely impact the company's cash flow, and it is the financial manager's job to be able to see when and where to borrow or spend money to be of greatest benefit to an organization, taking into account revenue forecasts and expenses, and they must look at all aspects of the financial statements. While a financial manager cannot actually predict the future, they must have a good grasp on the economy both locally and nationally in order to appropriately gauge the ability to repay an outstanding debt, such as obtaining new or additional capital. Part of this would include creating a capital expenditure budget to evaluate capital expenditure proposals. Finally, if I was a financial manager of a healthcare organization, I would want to know what the return on investment, or ROI, would be. Return on investment is a performance measurement of operating income divided by assets invested and can show the profit margin as well as the asset turnover. As a manager, your goal is to have a favorable profit margin or a favorable ROI, showing a net gain from your investment. If I did not believe that there would be a significantly favorable ROI from obtaining additional capital, then I would probably avoid such an investment. I would closely review both of the operating budgets and capital expenditure budgets to parse out as many flexible and variable costs as possible when making assumptions and forecasting a budget for a single or multi-year plan, as I would not want to put any undue financial distress on the company. I would also consider different forms of capital such as bonds, stocks, venture capital, and loans to determine the best option for a company's future. I would want to ensure any investment is in line with the mission, vision, and values of the organization, moving us into the future of better quality healthcare. In our biblical reading this week, it discussed being a good steward of time. Time is a resource that we cannot get back. Once it's gone, it's gone. So goes the cliche credited to Bill Keane. Yesterday is in the past, tomorrow is the future. Today is a gift, which is why it is called the present. Time is a gift. 1 Corinthians 4:2 states, "Moreover, it is required of stewards that they be found trustworthy." That is, we are to be trustworthy in all we do and say, as well as how we spend our time. We are to be diligent in the preparing of budgets and not falsify them to make our organization look better than it truly is. Such acts are foolishness. We must always trust the Lord will guide our paths, even when things do not work out the way we had planned. Ephesians 5:15-17 says, "Look carefully then how you walk, not as unwise, but as wise, making the best use of time, because the days are evil. Therefore do not be foolish, but understanding what the will of the Lord is." Thank you for spending time with me. Blessings. Carla.